Before we begin, it is critical to understand that this video is for educational and informational purposes only. I am not a financial advisor, and the content presented here should not be construed as financial, legal, or tax advice. The information is based on general principles and may not be suitable for your individual circumstances. Always consult with a qualified and licensed professional before making any financial decisions. Your financial situation is unique, and any action you take based on the information in this presentation is strictly at your own risk. What if I told you that the single greatest financial danger to your family isn't a stock market crash, a housing bubble, or a recession? It's a single phone call, the one that comes in the middle of the night, the one that changes everything forever. In that moment, love and grief are all that should matter. But for millions of American families, something else immediately rushes in: fear. Cold, hard financial fear. How will we pay the mortgage next month? The car payment is due on the 15th. What about the credit card bills? What about college? What about everything? The person they loved, the person who provided, is gone. But the bills are immortal. They never die. This is the nightmare scenario that a simple, powerful financial tool was invented to prevent. It's called life insurance. And yet, it is arguably the most misunderstood, misrepresented, and feared financial product in the United States. It's been buried under a mountain of myths, lies, and deliberate confusion, pushed by slick salespeople and whispered about at family barbecues. These misconceptions are not harmless. They are dangerous. They are the reason that over 40% of Americans who know they need life insurance simply don't have it. They are leaving their families one heartbeat away from financial ruin. My promise to you in this video is simple. We are going to take a sledgehammer to the 5 biggest, most destructive myths about life insurance. We're not going to talk in confusing jargon. We're going to use real numbers and real-world examples. By the time you finish watching, you will have the clarity and confidence to make the right decision for your family. You will know exactly how to see through the noise and protect the people you love without getting ripped off. We will expose the truth behind these 5 lies. 1. It's just way too expensive. 2. I'm young and healthy, I don't need it yet. 3. I'm covered through my job, so I'm good. 4. It's a terrible investment, I'd rather invest the money myself. And 5. The big one. The process of getting it is a complicated nightmare. Let's get started. The first and by far the most common myth, the one that stops most people dead in their tracks, is the belief that life insurance is outrageously expensive. When you hear the words life insurance premium, your mind probably jumps to a number that looks like a car payment or even a second mortgage. You imagine hundreds of dollars flying out of your account every single month for the rest of your life. And I get it. That thought is enough to make anyone say, "No thanks, I'll take my chances." But what if I told you that you've been lied to? Not just a little white lie, but a massive fundamental misunderstanding of the cost. A recent study by the research group LIMRA found that more than half of all Americans overestimate the true cost of life insurance by more than 3 times. Let me say that again. They think it costs $300 a month when in reality it's closer to $100. They think it's $100 when it's closer to $30. For younger generations, it's even worse. Millennials overestimate the cost by more than 5 times. They're walking around thinking a policy costs them $250 a month when they could likely get the exact coverage they need for less than $50. Let's put this in perspective. What do you spend $30, $40, or $50 a month on without even thinking about it? A few fancy coffees from Starbucks? Your Netflix, Hulu, and Disney Plus subscriptions combined? One pizza night for the family? We're talking about that level of expense. We are not talking about a car payment. So let's stop talking in hypotheticals and use some real concrete numbers. Let's take a healthy 35-year-old man who doesn't smoke. He wants to make sure that if he's gone, his wife and 2 young kids have enough money to pay off their $300,000 mortgage. He could likely get a 20-year term life insurance policy with a $500,000 death benefit for around $30 to $40 a month. $30 for $500,000 of protection. That's $1 a day to guarantee that the home his family lives in is theirs free and clear, no matter what happens to him. Let's try another one. A healthy 30-year-old woman, a non-smoker. She's single, but she has significant student loan debt that her parents co-signed for. She doesn't want to leave them with that burden. She could get a $250,000 30-year term policy for probably less than $25 a month. Less than the cost of a single dinner out. So if it's this affordable, why does everyone think it's so expensive? The answer lies in the confusion between two fundamentally different types of life insurance: term and whole life. This is the secret the industry doesn't always want you to understand clearly. Think of term life insurance like renting an apartment. You pay a relatively low, fixed price for a specific period of time, the term. Say 10, 20, or 30 years. You choose this term to cover your period of greatest financial need. For example, the 20 years it takes for your kids to grow up and become independent, or the 30 years it takes to pay off your mortgage. If you pass away during that term, your family gets the full tax-free death benefit. If you outlive the term, the policy simply expires. You paid for protection and thankfully you didn't need it. It's pure, simple, and incredibly cheap protection. It's like car insurance for your life. You pay for it hoping you never have to use it. Now, on the other hand, you have whole life insurance. Think of this like buying a house. It's designed to last your entire life. And the premiums are dramatically higher. Why? Because it's not just a death benefit. It's a hybrid product that combines life insurance with a savings or investment component called cash value. A portion of your high premium goes to the cost of the insurance, and another portion goes into this cash value account, which grows very, very slowly over time. This is the product that slick salespeople often push because the commissions are massive. They sell it as a forced savings plan or an investment. And when people get a quote for a whole life policy, they see a number like $300, $400, or $500 a month and get sticker shock. They walk away thinking, I knew it, life insurance is a total ripoff, and they end up buying nothing. They let the perfect become the enemy of the good. They were trying to buy a mansion when all their family really needed was a simple, affordable roof over their heads. For the vast majority of American families, term life insurance is the answer. It provides the maximum amount of protection for the lowest possible cost during the years you need it most. Whole life and other permanent insurance products can be valuable tools, but typically for very specific, complex estate planning or for very high net worth individuals, not for the average person trying to make sure their mortgage gets paid and their kids can still go to college. So the first, most important step is to shatter this myth in your own mind. Life insurance is not expensive. The wrong kind of life insurance is expensive. Securing hundreds of thousands, or even millions of dollars in pure protection for your family is likely cheaper than your monthly cell phone bill. It's a financial safety net, not a luxury item. And knowing that it's affordable is the first step. But that often leads directly to the next dangerous misconception, the one that whispers, sure, it might be cheap, but why rush? This is the voice of procrastination. It's the single most expensive voice you will ever listen to when it comes to your financial future. And it's the sound of misconception number 2. I'm young and healthy. I'll get it later. It sounds so reasonable, doesn't it? Almost responsible. Why pay for something you probably won't need for 50 years? Why not put that money toward a down payment, student loans, or a vacation? The logic feels sound, but it's a trap. It's a financial illusion that has cost American families fortunes, and in the worst cases, their entire financial security. To understand why, I want to tell you a quick story about a couple we'll call Mike and Jessica. They were 28 years old, high school sweethearts who had finally scraped together enough to buy their first small home in a suburb outside of Austin. They were the definition of young and healthy. They ran 5 Burmese chats on the weekends, ate reasonably well, and their biggest health concern was the occasional seasonal allergy. They had a mortgage, 2 car payments, and were talking about starting a family in a year or 2. Their financial advisor, a family friend, told them, you guys need to get term life insurance. Now, while it's dirt cheap, Mike looked at the numbers. For a $500,000 policy, enough to cover the mortgage and replace his income for a few years, it was going to be about $30 a month. Jessica's was even less. But Mike did the math. $30 a month is $360 a year. He said, look, let's just wait. We're perfectly healthy. Let's put that $360 toward the principal on the house this year. We'll get the insurance next year when we get our raises. Jessica agreed. It made perfect sense. A guaranteed return on the house versus paying for something they wouldn't need. It was the logical choice. About 8 months later, Mike was playing in his weekly pickup basketball game. He went up for a rebound, landed awkwardly, and felt a sharp pain in his back. He figured it was just a pulled muscle. But after a few weeks of persistent nagging pain, he went to the doctor. They did an MRI just to be safe. The doctor came back into the room with that look on his face. The one you see in movies. It wasn't a pulled muscle. It was a tumor on his spine. The diagnosis was a form of cancer that, while treatable with a very high success rate, was still cancer. Their world was turned upside down. But through the fear and the countless appointments, Mike was a fighter. He went through treatment, and a year later he was in remission. He was cancer-free. He was, once again by all accounts, healthy. Life started to get back to normal. And as they were re-evaluating their finances after the medical bills, they remembered the life insurance. They called the advisor back, ready to finally sign up. They were still young, now 29, and Mike was healthy again. They assumed the price might go up a tiny bit. The advisor ran the quotes. Jessica's policy was approved instantly, still incredibly cheap. But for Mike, the same $500,000 policy that was $30 a month just 18 months earlier? He was now completely uninsurable on the private market. Denied. Not a higher price. Not a different plan. Just a flat-out no company would touch him. The window of opportunity, that brief period where he was a perfect low-risk candidate, had slammed shut forever. They had made the logical choice to wait, and in doing so, had gambled with their future and lost. Mike will likely never be able to get affordable life insurance again. Their mortgage, their future kids' college education, Jessica's financial safety. It all now rests on his continued good health, with no safety net. This story, or versions of it, happens every single day. Because when you say, "I'll get it later," what you're really doing is making two of the worst bets you can possibly make. You're betting against your age, and you're betting against your health. Let's break that down. First, you're betting against age. Life insurance is one of the few things in the world where being younger gives you an almost unfair advantage. The price you pay is based on your risk of dying. The younger you are, the lower the risk and the lower the premium. But the most crucial part is this. With a term life insurance policy, you can lock in that rate. Let's use some real-world numbers. A healthy, non-smoking 30-year-old man might get a $500,000, 20-year term policy for about $28 a month. That's a locked-in rate. For the next 20 years, until he's 50, his payment will always be $28 a month. Now let's say he decides to wait. He's too healthy and wants to save the money. He waits until he's 40. He's still in great shape, no health issues. He applies for the exact same $500,000 20-year policy. His new quote? It's not $28 anymore. It's closer to $47 a month. By waiting 10 years, he's now paying an extra $19 a month. That doesn't sound like much, but over the 20-year term of the policy, he will pay an extra $4,560. That's the cost of his procrastination. That's his waiting tax. What if he waits until he's 50? That same policy will now cost him around $120 a month. By waiting, he's guaranteed to pay tens of thousands of dollars more for the identical product. Buying life insurance young isn't about expecting to die. It's about using your age to lock in the lowest possible price for the protection you will eventually need. It's a pure financial arbitrage on your youth. But betting against your age is the safer of the two bets. The second bet, betting against your health, is like playing Russian roulette with your family's future. Every single year you wait is another 365 days for something to go wrong. You could develop high blood pressure. Your cholesterol could creep up. You could get a sleep apnea diagnosis. You could gain 30 pounds. You could have a mental health diagnosis like anxiety or depression that requires medication. To you, these are just parts of life. To an insurance underwriter, they are red flags. Each one adds dollars to your monthly premium. Or like in Mike's story, a more serious diagnosis can make you completely uninsurable at any price. You don't get credit for being healthy last year. You only get today. The health you have right now, this very second, is the most valuable and most insurable asset you own. It will never be better than it is today. Every day you wait, you are rolling the dice, hoping that nothing new shows up on a medical chart before you decide to apply. You are actively gambling that your perfect health will hold out just one more year. It is a terrible, terrible bet. So the idea that you should wait until you're older or have kids or have a bigger mortgage is completely backward. That's like waiting for your house to catch fire before you shop for homeowners insurance. The time to get it is when you need it the least. Because that is when it is the cheapest, and that is when you are guaranteed to be approved. You are buying it not for the person you are today, but for the person you will be in 5, 10, or 20 years, and for the family that will depend on them. You are locking in a promise to them, using the one thing you have right now that is guaranteed to diminish, your youth and perfect health. So you're convinced. You see the logic. Waiting is a losing game. You're ready to protect your family and lock in your rate. But then a thought pops into your head. A comfortable, convenient thought that might be the most dangerous of all. Wait a minute. I have life insurance through my job. I'm all set, right? Right? That question, that one single seemingly logical question, is the foundation of our third major misconception, and frankly, it might be the most financially devastating of them all. Misconception number 3. My life insurance through work is enough. On the surface, it makes perfect sense. Your company offers it, it's usually free or incredibly cheap, maybe just a few dollars a month deducted from your paycheck. Often it's 1 or 2 times your annual salary. If you make $80,000 a year, you see a $160,000 death benefit and think, wow, that's a huge number. My family would be set. You check the box during open enrollment, you feel responsible, you feel secure, and you never think about it again. But this feeling of security is an illusion. It's a financial house of cards built on a foundation you don't own and can't control. Relying solely on your employer's life insurance is like building your dream house on rented land. It looks great, it feels like yours, but at any moment the landlord can change the terms, raise the rent, or simply tell you to leave. The single biggest danger, the one that catches millions of Americans off guard, is a concept called portability, or in this case, the lack of it. That life insurance policy is tied directly to your job. The moment you leave that job, whether you get laid off, find a better opportunity, retire, or decide to start your own business, that coverage evaporates. Poof, gone. Think about that. Let's imagine a guy named Mark. Mark's been a loyal employee at a manufacturing company for 20 years. He's 52 years old. He has the standard 2x your salary life insurance plan. He and his wife have a mortgage, a kid just starting college, and the usual collection of car payments and credit card debt. He feels protected. One Friday afternoon, his division gets restructured. Mark is laid off. Along with his final paycheck, his health insurance, and his parking spot, his life insurance policy vanishes. Now, Mark has to go out on the open market and find a new policy. But he's not a healthy 32-year-old anymore. He's 52. He's developed high blood pressure, he's maybe a little overweight. The price for a new individual policy is suddenly 5, maybe 10 times what he was paying, if he can even get approved at all. He's in a terrifying position. At the exact moment in his life when his family's financial risk is at its peak, he's suddenly uninsured and potentially uninsurable. His free benefit from work just became the most expensive mistake of his life. This isn't a rare scenario. It happens every single day. The average person changes jobs over a dozen times in their career. Tying your family's entire financial safety net to your current employer is a gamble of epic proportions. But let's say you're lucky. Let's say you plan to stay at your job forever. The second critical flaw in the work is enough mindset is the amount of coverage itself. 1 or 2 times your salary sounds like a lot of money. It's not. It's a band-aid for a bullet wound. Let's go back to that $160,000 policy for the person making $80,000 a year. What does that money actually have to do? First, you'd pay for a funeral, which can easily cost $10,000 to $15,000. So we're down to $145,000. Then there's the mortgage. Let's say there's $200,000 left on it. Well, the policy doesn't even cover that. But let's be generous. Let's say the mortgage is paid off, but there's $30,000 in student loans and car debt. Now we're at $115,000. The biggest expense, the one everyone forgets, is income replacement. Your $80,000 salary is gone. Forever. How is your spouse supposed to pay the property taxes, the utility bills, the grocery bills, put gas in the car, and save for retirement on their own? How long will that $115,000 last? A year? Maybe 2 if they're extremely frugal? And what about college for the kids? A single year at a state university can be $25,000 or more. That entire death benefit could be wiped out before your youngest child even finishes high school. Relying on a work policy to protect your family is like trying to put out a house fire with a water pistol. It makes you feel like you're doing something, but in the end, the house is still going to burn down. Financial experts often recommend having a death benefit that is 10 to 15 times your annual income. Not 1 or 2. That's the amount needed to truly pay off all debts, fund future goals like college, and create an investment portfolio that can replace your income for decades to come. The third fatal flaw is the issue of control. You don't own your work policy. The company does. They are the policyholder. You are just a name on a certificate as part of a group plan. What does this mean? It means they can change the terms anytime they want. During the next contract negotiation, they might decide to cut costs by reducing the death benefit from 2x your salary to 1x your salary. Or they could switch insurance carriers to a company with more restrictions. They could even eliminate the benefit entirely. You have absolutely zero say in the matter. You are renting your family's security, and the landlord can change the lease whenever they want. This creates a dangerous set of golden handcuffs. I spoke with a woman named Jennifer who was miserable in her corporate job. She was brilliant, had a great idea for her own consulting firm, but she was terrified to leave. Why? Because a few years prior she had a health scare. Nothing major, but it would make getting a new, affordable life insurance policy difficult. Her employer-sponsored plan was the only thing she had. She felt trapped in a job she hated, forced to sacrifice her dreams and her happiness because her family's financial security was chained to her HR department. So what is the answer? Is group life insurance from your employer a bad thing? Absolutely not. It's a fantastic perk. Think of it as a wonderful supplement. It's the appetizer, not the main course. It's the spare tire in your trunk, not the 4 tires you drive on every day. The solution is to use your work insurance for what it is, a nice little bonus, and secure your own private, individual life insurance policy that you own and control. A policy that isn't dependent on your boss, your company's profitability, or your employment status. A policy that stays with you if you get laid off, if you start a business, if you move across the country, or if you decide to take a year off to travel the world. A policy with a death benefit that is actually sufficient to protect your family, pay off the mortgage and secure their future, not just for a year or two but for the long haul. You need a foundation of protection that you own. Something nobody can ever take away from you. Okay, so you're convinced. The work policy isn't enough. You understand you need to take control and get a policy of your own. You start looking around, you go online, you talk to a few people. And that's when you enter a whole new world of confusion. You see all these different names. Term life, whole life, universal life, indexed universal life. Your head starts to spin. And then you hear it. Maybe from a well-meaning relative, maybe from a slick salesman in a suit, or maybe you read it on a blog somewhere. Someone leans in and tells you with the utmost confidence that buying simple term life insurance is the same as just throwing your money away. And that single persuasive phrase leads us directly into our fourth, and perhaps the most hotly debated misconception in the entire world of personal finance. The misconception is that term life insurance is a bad deal because you get nothing back if you outlive the policy, while whole life insurance is a brilliant combination of protection and investment. It's pitched as the responsible, savvy choice. It's the Swiss Army knife of personal finance. You get a death benefit and you build a cash value that you can borrow against or cash out later. It's insurance and savings all wrapped up in one neat, tidy package. What's not to love? Well, a lot actually. And to understand why, we need to talk about a toaster. Imagine you're shopping for a new kitchen appliance. You see 2 options. Option 1 is a high-quality, reliable toaster. Costs $50. It does one thing and it does it perfectly. It makes great toast. Option 2 is a brand new invention. The toaster fridge. It's a combination refrigerator and toaster, all in one unit. It costs $2,000. The salesman tells you it's a brilliant investment. Why buy 2 separate things, he says, when you can have it all in one? You'd laugh him out of the store, right? You know instinctively that the toaster fridge is going to be a terrible toaster and an even worse refrigerator. It's going to be expensive, inefficient, and when one part breaks, the whole thing is useless. Whole life insurance is the toaster fridge of the financial world. It tries to do 2 jobs at once: provide a death benefit and act as an investment vehicle. And just like the toaster fridge, it does both jobs poorly. Let's break down exactly why the pitch that sounds so good on the surface is, for the vast majority of Americans, a deeply flawed financial strategy. The first problem is the cost. It's astronomical. The premiums for a whole life policy can be 10, 20, even 30 times higher than the premium for a term life policy with the exact same death benefit. We're not talking about a small difference here. We're talking about the difference between paying $30 a month and paying $600 a month. And where does all that extra money go? Well, a huge chunk of it goes to fees and commissions. Whole life insurance is one of the most lucrative products for an insurance agent to sell. The commissions are massive, often equaling 50% to over 100% of the first year's premium. That's $600 a month you're paying? In the first year, thousands of dollars of that might go directly into the salesperson's pocket, not into your cash value. Then you have the internal costs of the policy itself. Administrative fees, mortality charges, expense charges. All of these are quietly siphoned out of your premium payments before a single penny ever starts to grow in your cash value account. For the first few years of a whole life policy, it's not uncommon for your cash surrender value, the money you'd actually get back if you canceled, to be zero. You could pay in $10,000 and walk away with nothing. The second problem is the abysmal investment returns. The cash value portion of your policy grows at a rate that is often opaque, and when you finally do the math, incredibly low compared to other simple investment options. They might guarantee a rate of 2% or 3%, which barely keeps up with inflation, if at all. Even with dividends, the long-term historical returns of a whole life policy's cash value pale in comparison to what you could achieve by simply investing in a low-cost S&P 500 index fund. This brings us to the single most powerful concept that dismantles the whole life argument. It's a strategy championed by financial experts for decades, and it's called buy term and invest the difference. It's so simple yet so profound. Let's put some real numbers to it. Meet Sarah. She's 35, healthy, and wants a $1 million life insurance policy to protect her family. She gets two quotes. Quote 1 is for a whole life policy. The premium is a whopping $800 per month. The agent tells her that in 30 years, when she's 65, she'll have a nice cash value of around $400,000 built up. Sounds okay, right? Quote 2 is for a 30-year term life policy. Same $1 million death benefit. The premium? Just $60 per month. Now let's apply the magic. Sarah chooses the term policy. She pays her $60 a month for the insurance her family needs. Then she takes the difference. The $740 she's not sending to the insurance company every month, and she invests it. She sets up an automatic transfer of $740 every single month into a simple, low-cost Roth IRA and a brokerage account, invested in an S&P 500 index fund. She does this for 30 years. Let's fast forward. Sarah is now 65. Her kids are grown, her house is paid off, and her 30-year term policy is about to expire. She's sad because she never got anything back from it, right? Wrong. Let's look at her investment account. That $740 she invested every month for 30 years, earning a historically average market return of, let's be conservative and say 9% per year? It hasn't grown to $400,000 like the whole life policy's cash value. It has grown to over $1.3 million. Let me repeat that. By choosing to separate her insurance and her investments, Sarah has the exact same $1 million protection for her family for 30 years, and at the end of it, she is sitting on a nest egg that is nearly $1 million larger than what the whole life policy would have given her. She is what we call self-insured. She doesn't need life insurance anymore because she has $1.3 million in the bank. That is her life insurance. That is her legacy. That is her financial freedom. The whole life salesman will come back with objections. But what about the tax advantages? The tax advantages of a Roth IRA, where all your growth and withdrawals in retirement are 100% tax-free, are far superior. But you can borrow against your cash value. You can also just withdraw money from your investment account without having to pay interest to an insurance company to borrow your own money back. But it's forced savings. People won't have the discipline to invest the difference. This is perhaps the most insulting argument of all. It assumes you are incapable of managing your own money. It suggests that the only way for you to save is to lock your money into a high-fee, low-return, inflexible product that enriches a salesperson. Don't fall for it. Setting up an automatic transfer to an investment account takes 10 minutes. Financial discipline is a skill you can learn, not a service you should pay a 100% commission for. The fundamental truth is this: life insurance should be for death protection. Investments should be for wealth creation. When you combine them, you compromise both. You get expensive insurance and a terrible investment. You get a toaster fridge. Buy the $50 toaster. It does its job perfectly. Buy the simple, inexpensive term life insurance policy that gives your family maximum protection for the lowest possible cost. Then, take the massive difference in price and invest it intelligently for your future. Do that, and you won't just be protecting your family in case of tragedy. You'll be aggressively building a future where they and you can thrive. So we've established that for most people, buying term and investing the difference is the clear mathematical winner. But this entire strategy hinges on one crucial and often overlooked detail: actually getting a policy. And that leads to our fifth and final misconception, one that stops millions of Americans from even applying in the first place, because they believe a simple mistake from their past will automatically disqualify them forever. I have a pre-existing condition. I got a DUI a few years ago. I struggled with my mental health. I declared bankruptcy. I used to smoke. The list of reasons we tell ourselves that we can't get life insurance goes on and on. We carry these moments from our past like scars, convinced that they've branded us as uninsurable. And that single word, uninsurable, feels like a financial death sentence for our family's future. But for the vast majority of people who believe it, it is a complete and total lie. The life insurance industry is not in the business of judging your past. It's in the business of calculating your future risk. And there's a world of difference between the two. Let me tell you about a guy named Mark. By his early 40s, Mark had built a great life. A loving wife, 2 young kids, a small but growing contracting business. He was the picture of a responsible American dad. But every night, after he'd tucked his kids into bed, a cold knot of anxiety would tighten in his stomach, because Mark had a secret, or rather a history. His 20s were messy. A DUI at 22. A bout with severe depression at 25 that required therapy and medication. To him, these weren't just past events. They were permanent stains on his record. He'd see commercials for life insurance and just scoff, thinking to himself, yeah, right? They'd take one look at my file and laugh me out of the office. He carried this immense guilt, this toxic belief that because of the man he used to be 15 years ago, he was failing to protect the family he had now. He was convinced he was uninsurable. Mark's story is incredibly common. Millions of us believe that the doors to financial protection are slammed shut because of a health diagnosis or a mistake we made long ago. But here's the fundamental truth you need to understand. Underwriters, the people who actually approve or deny your application, are not moral gatekeepers. They are risk analysts. Their job is to look at a complete, holistic picture of your life and assign a price to the risk you represent. They deal in data, in patterns, and in probabilities, not in judgment. Your past isn't a character flaw to them. It's a data point. And data points can be managed. Let's break down the big ones. First, pre-existing health conditions. This is the giant. People hear cancer, diabetes, or heart disease, and they immediately assume it's game over. That's simply not true. The key isn't the diagnosis itself. It's the management and the time. Let's take diabetes. If you have uncontrolled type 2 diabetes with an A1C of 11, you're going to have a very hard time. But if you have it managed with diet, exercise, and medication, and your A1C is a stable 6.8, dozens of carriers will be happy to offer you a policy. They see control. They see stability. They see a manageable risk. What about a history of cancer? Again, it's not an automatic no. It depends entirely on the type, the stage, and most critically, how long you've been in remission. If you were diagnosed with stage 1 skin cancer that was removed a decade ago, it might barely affect your rates. If you finished treatment for a more serious cancer 5 years ago and have been cancer-free ever since, you've crossed a massive threshold in the eyes of an underwriter. They see a survivor, not a liability. Even mental health, a topic that used to be a complete non-starter, is viewed with far more nuance today. If you're actively managing anxiety or depression with a therapist or a stable long-term medication plan, it demonstrates responsibility. It shows the underwriter that you are taking control of your health. An unmanaged condition is a high risk. A managed one is often an acceptable risk. Now let's talk about lifestyle and legal issues like Mark's DUI. A DUI is serious, and insurance companies do not take it lightly. If you got one last month, you're almost certainly going to be postponed for at least a year. The insurer needs to see that it was an isolated incident, not a pattern. But what if it was like Mark's, a single mistake from over a decade ago with a perfectly clean driving record ever since? To most carriers, that's ancient history. It's a non-factor. Time is the great healer of underwriting records. A single DUI from 7 years ago might get you a standard rate. From 10 years ago, it might not even be a consideration for a preferred rate. It's the same with finances. A bankruptcy discharged 7 years ago, with a history of re-established good credit since, is rarely an issue. They just want to know you're financially stable enough to continue paying your premiums. So, how do you navigate this? If you have a few bumps and bruises in your past, what's the game plan? First, and this is the most important rule, be radically honest. Do not lie on your application. Do not omit that you were a smoker, or that you take blood pressure medication. Lying on a life insurance application is fraud. If you pass away within the first 2 years of the policy, known as the contestability period, the company has the right to investigate. And they will. They will pull your medical records, your pharmacy records, and your DMV report. If they find you lied about a material fact, like being a smoker when you check the non-smoker box, They will deny the claim. Your family won't get $1 million. They'll get a small check for the premiums you paid back and a letter of denial. The temporary pain of a higher premium is infinitely better than the permanent devastation of a denied claim. Honesty is your only option. Second, be your own best advocate. Document everything. If you have high blood pressure, don't just say it's controlled. Get a letter from your doctor detailing your treatment plan and stable readings for the last 2 years. If you've been sober for 10 years, be proud of it. If you've been in remission for 5, get the paperwork to prove it. You're not just an application number. You're a story. Give the underwriter the information they need to see the full positive story of your life today, not just the negative data point from your past. And third, and this is the ultimate cheat code, work with an independent broker. A captive agent who only works for one company can only offer you that one company's opinion of your risk. If they say no, you're out of luck. But an independent broker works for you. They have access to dozens of different insurance carriers, and they know the secrets. They know that Company A is incredibly strict about DUIs, but is surprisingly lenient with well-managed diabetes. They know Company B will decline you for a certain heart condition, but Company C specializes in it and might even offer you a great rate. An independent broker can take your unique history, your specific story, and confidentially shop it around to find the carrier that will view you in the most favorable light. This is, without a doubt, the single best way to turn a potential no into a yes. This is exactly what happened with Mark. A friend finally convinced him to just talk to an independent broker. Mark walked in expecting rejection and laid it all out on the table. The DUI from 15 years ago, the history of depression that had been stable and managed for over a decade. The broker didn't flinch. He just nodded and said, "Okay, I can work with this." He knew exactly which 2 or 3 carriers would be the best fit. Mark applied, was completely honest, provided a letter from his doctor about his mental health stability, and a few weeks later he was approved. It wasn't the rock-bottom super preferred rate, but it was a solid, affordable standard policy for $1 million. And the moment he made that first premium payment, Mark said that 15 years of guilt and anxiety just evaporated. The weight was gone. He was no longer the guy defined by his past mistakes. He was the man who secured his family's future. The word uninsurable is a myth we tell ourselves. Life insurance isn't about being perfect. It's about being prepared. It's about taking an honest look at your reality, your health, your history, your life, and finding a company that is willing to partner with you to protect the people you love. Your past is a data point, not a verdict. So now you know the truth behind the 5 biggest myths. You know you're not too young, you're not too old, it's not too expensive, it's not just for the wealthy, and your past doesn't automatically disqualify you. You're ready to take the next step. But this is where the single most expensive mistake is made. It happens right on the application, and it has nothing to do with lying. It's a subtle choice that can cost your family hundreds of thousands of dollars when they need it most. And in the next part, we're going to expose exactly what that mistake is and how you can avoid it. The most dangerous mistake isn't a lie. It's an assumption. It's the assumption that the life insurance you get through your job is a safety net, when in reality, it's a tightrope. This brings us to the second biggest misconception about life insurance in America. My group policy from work is good enough. This belief is financially catastrophic for millions of families, and it's one of the most deeply ingrained myths we have. You start a new job, you go through the benefits package, you see life insurance, and you check the box. Feels responsible. Feels easy. And that's the problem. The security it offers is an illusion, built on a foundation that can vanish overnight. Let's break down why relying solely on your employer's life insurance is one of the riskiest financial decisions you can make. The number 1 reason is the most simple. You don't own it. Your employer does. Think about it. You wouldn't rely on the company car as your family's only vehicle. You wouldn't consider the company laptop your personal computer for life. So why would you entrust your family's entire financial future to a policy that is completely out of your control? When your employment ends for any reason, the life insurance usually ends with it. You get a better job offer and decide to leave? The policy is gone. Your company has to downsize and you get laid off? That safety net disappears the exact moment you need it most. You decide to retire after a long career? Congratulations, but your life insurance is probably not coming with you. Let me tell you about a man named Mark. Mark was a 52-year-old engineer, a classic company man. He'd been with the same firm for nearly 20 years. He had their group life insurance policy, a respectable 2 times his salary, about $200,000. He felt secure. He was healthy, he was stable. But then the market shifted. His company was acquired, and his entire division was eliminated. At 52, Mark was out of a job. And with his job went his life insurance. Now you might think, okay, he'll just go get his own policy. But here's the cruel twist. During a routine checkup a year before he was laid off, Mark's doctor had found he had developed type 2 diabetes. When he was covered by the group plan, it didn't matter. But now, in the open market, at 52 years old with a new pre-existing condition, getting affordable life insurance was practically impossible. The quotes he received were 5, 6, 7 times what a healthy person his age would pay. It was financially crippling. 2 years later, Mark suffered a fatal heart attack. His family, who thought they were protected by a $200,000 policy, received nothing. Not a single penny. His wife had to sell their home. His kids' college funds vanished. Their lives were turned upside down not because Mark was irresponsible, but because he put his faith in a benefit that was never truly his. That story is heartbreaking, and it happens every single day. The insurance you get at work is a temporary perk, not a permanent plan. It's a golden handcuff designed to keep you tied to your desk. The second reason your work policy isn't enough is the amount. The coverage is almost always woefully inadequate. A typical group plan offers a death benefit of 1 to 2 times your annual salary. Let's say you make $80,000 a year. A 2 times salary policy gives your family $160,000. To a lot of people, that sounds like a huge amount of money. But let's do the math. Your family has a mortgage with $200,000 left on it. They have $10,000 in credit card debt and a $30,000 car loan. That's $240,000 in debt alone. Your $160,000 policy from work doesn't even clear the debt, let alone replace your income. Forget replacing your income for a few years while your spouse gets back on their feet. Forget paying for your kids' college education. Forget covering daily expenses like groceries, utilities, and healthcare. That money is gone before it even has a chance to help. Financial experts recommend having a life insurance policy that is 10 to 12 times your annual income. Not 1 or 2, 10 to 12. So if you make $80,000 a year, you should be looking at a policy for $800,000 to $1 million. The policy from your job isn't a rounding error, but it's dangerously close to one when you look at the real numbers. It gives you a false sense of security, making you think you've checked the box, when you've barely made a dent in what your family would actually need. And this leads to the third problem: the illusion of free. Many companies offer a basic one-time salary policy for free as part of your benefits package. And we're all conditioned to love free stuff. But in the world of insurance, free is a warning sign. It's cheap because it's not designed for you. It's a blanket policy meant to cover thousands of employees of all ages and health conditions. It's not underwritten for you as an individual. This means if you're young and healthy, you are effectively subsidizing the premiums for older, less healthy colleagues. You could get far more coverage for less money on your own, with a policy that's actually tailored to your life. The free policy is just enough for the company to list it as a benefit on their hiring brochure. It's a marketing tool for them, not a protection plan for you. Now the HR department might tell you, don't worry, if you leave the company, you can take the policy with you. It's portable. This is perhaps the most deceptive part of the entire arrangement. Yes, you can often port your group coverage, but what they don't tell you is that the cost will explode. You're not keeping that cheap group rate. You are converting your group term insurance into an individual whole life insurance policy, and the insurance company is going to charge you a premium based on your current age and health, without a medical exam. Because they're taking on a bigger risk, especially since people who choose to port policies are often the ones who know they can't get coverage elsewhere. The price is astronomical. We're talking about premiums that can increase by 500 or even 1,000%. That $100 a month benefit suddenly becomes a $1,000 a month bill, right when you've lost your primary source of income. It's a trap. It's a feature that looks good on paper, but is designed to be so unaffordable in practice that almost no one can actually use it. So what's the answer? It's simple. You need to own your own policy. A private term life insurance policy is your asset. You control it. The price is locked in for the duration of the term, whether it's 20 or 30 years. It doesn't matter if you change jobs, get sick, or move across the country. As long as you pay your premium, that coverage is yours. It's a contract between you and the insurance company, with no middleman, no employer who can pull the rug out from under you. Think of the group policy from your job as a small complementary umbrella. It's nice to have if you get caught in a light drizzle. But your family's future isn't a drizzle. It's a potential hurricane. For a hurricane, you need a house. You need solid walls and a foundation. A private, individual term life insurance policy is that house. It's the only way to guarantee that your family is truly protected, no matter what happens at your job. So you're convinced. You see that the work policy is a trap and you need to get your own. You go online ready to do the right thing, and you're immediately hit with a confusing high-pressure choice: term life versus whole life. And almost immediately, you'll hear the argument that buying term life insurance is like renting your coverage, that it's a complete waste of money if you outlive the term. This is misconception number 3. And it is, without a doubt, one of the most profitable and misleading sales pitches in the entire financial industry. It's the lie that convinces millions of well-meaning people to buy complex, expensive policies that they can't afford, causing them to eventually cancel the policy and lose every single dollar they paid in. In the next part, we are going to finally settle the term versus whole life debate and expose the truth they don't want you to know. This is it. The single biggest, most contentious, and most misunderstood battle in the entire world of personal finance. It's a conflict that has cost American families trillions of dollars over the decades. Term versus whole life. On one side, you have an army of financial gurus, bloggers, and consumer advocates screaming from the rooftops that one is a simple, elegant solution. On the other, you have an even bigger, better-funded army of insurance agents in sharp suits, armed with glossy brochures and complex charts, telling you the exact opposite. They both can't be right. So who's telling the truth? Let's cut through the noise. To understand this, you have to understand what each product actually is at its core. Let's start with term life insurance. The name tells you everything you need to know. You buy it for a specific term, usually 10, 20, or 30 years. You pay a fixed monthly premium. If you pass away during that term, your family gets a tax-free, lump sum death benefit. If you don't pass away during that term, the policy expires and that's it. You got exactly what you paid for. Peace of mind and protection for your family during the years they needed it most. Think of it like renting an apartment. You pay your rent every month for the right to live there. When your lease is up, you move out. You don't get your rent money back, but you had a roof over your head. Term insurance is pure, simple, and incredibly cheap protection. It does one job, and it does it exceptionally well. Now let's talk about whole life insurance. This is where things get complicated, and that complexity is not an accident. It's a feature designed to benefit the seller, not you. Whole life, also known as permanent insurance, is pitched as a 2-for-1 deal. It's part life insurance and part savings or investment vehicle. Your much higher premium is split into 2 buckets. A portion of it goes to cover the actual cost of the insurance, the death benefit. The other, larger portion goes into a cash value account that is supposed to grow over time, tax deferred. The agent will tell you it's a forced savings plan. They'll tell you that you can borrow against this cash value or even cash it out later in life. It sounds great, right? Insurance for your whole life plus a built-in retirement plan. This is the sales pitch. Now here is the truth they don't want you to know. First, let's talk about cost and commissions. While a healthy 30-year-old might get $1 million 20-year term policy for about $50 a month, a whole life policy with the same death benefit could cost them $500, $600, or even $800 a month, 10 to 15 times more. Why the staggering difference? Because a massive chunk of your early payments, and I mean massive, goes directly into the agent's pocket as commission. It's not uncommon for an agent to earn 90 to 110% of your entire first year's premium as their commission. Let me say that again. If your premium is $600 a month, that's over $7,000 a year. The agent could be pocketing all of it. This creates a powerful, almost irresistible financial incentive for them to push this product on you, whether it's right for you or not. They aren't selling you a solution. They are selling you their commission. Second, the investment part is, to put it bluntly, terrible. The returns on the cash value portion of a whole life policy are notoriously low. After you account for all the hidden fees, administrative costs, and agent commissions, your money might grow at a guaranteed rate of just 1 to 2%. Compare that to the historical average of the US stock market, which is around 10% per year. The argument that it's safe and guaranteed falls apart when you realize that the opportunity cost is costing you hundreds of thousands, if not millions, of dollars in potential growth over your lifetime. They are selling you a tricycle for the price of a Ferrari and telling you it's safer because it can't go fast. Third, these policies are incredibly inflexible and punitive. If you hit a rough patch and can't make those huge monthly payments, You risk losing the policy and every single penny you've put into it. And that cash value they talk about? For the first several years, you have almost no access to it. It's eaten up by fees and something called surrender charges. If you try to cancel the policy in the first 10 or 15 years, the insurance company will hit you with a massive penalty, often wiping out your entire cash value. They have you locked in. Let's make this real. Imagine two 35-year-old friends, Mark and Jessica. They're in identical health and financial situations. Mark goes to an insurance agent who sells him a $1 million whole life policy. It costs him $700 per month. The agent tells him it's a great way to protect his family and save for the future. Jessica talks to a fee-only financial advisor. She buys a $1 million 20-year term life policy for just $60 a month. She takes the $640 difference and invests it every single month into a simple low-cost S&P 500 index fund. Now let's fast-forward 20 years. Mark is now 55. He's faithfully paid his $700 premium every month. He's paid a total of $168,000 into his policy. He checks his cash value statement. After fees and paltry returns, it's worth about $180,000. He's barely made any money on his investment. If he dies, his family gets $1 million. Now let's look at Jessica. Her 20-year term policy is about to expire, just as her kids are finishing college and her mortgage is nearly paid off, the exact time she needed the protection. She's also paid her $60 premium, totaling about $14,400 over 20 years. But what about the $640 she invested every month? Assuming a conservative 8% average annual return, which is below the historical market average, her investment account is now worth over $375,000. Let's compare. Mark has $180,000 in cash value. Jessica has over $375,000 in her investment account. She has more than double the cash, and her family was protected by the exact same $1 million death benefit the entire time. And she did it while spending less on the insurance portion. Who got the better deal? It's not even a debate. The strategy Jessica used has a name. It's called buy term and invest the difference. It is one of the most powerful and time-tested wealth-building strategies available to the average American family. It keeps your insurance and your investments separate. This is critical. Insurance should be for protection. Investments should be for growth. When you combine them into one expensive, confusing product like whole life, you get the worst of both worlds: overpriced insurance and a lousy investment. Now, is there ever a time for whole life insurance? Yes, for about 1% of the population. We're talking about the ultra-wealthy who have multi-million-dollar estates and are looking for complex ways to pass money to their heirs while avoiding estate taxes. If you have a team of accountants and estate planning attorneys, then yes, a permanent life insurance policy might be a small part of a very large, very complex financial strategy. For everyone else, for the teachers, the engineers, the small business owners, the nurses, it is almost always a financial trap. The truth is, the term versus whole life debate was settled decades ago by anyone who isn't earning a commission. For the vast majority of Americans, the answer is clear and overwhelming. Buy affordable term life insurance during the years your family depends on your income, and invest the rest for your future. Don't let a slick sales pitch separate you from your hard-earned money and your future wealth. So now that you know the type of insurance most people should get, the next million-dollar question is, how much do you actually need? $1 million? $500,000? 10 times your salary? The common rules of thumb are almost always wrong, and getting this number wrong can be just as devastating as buying the wrong kind of policy. In the next part, we're going to show you the simple formula to figure out the exact right amount for your family, and it's not what you think. So, what is this simple formula? First, let's talk about the formula almost everyone gets told, the one that's plastered all over the internet and pushed by lazy advisors. It's the 10 times your annual income rule. Sounds so simple, so clean. If you make $80,000 a year, you need an $800,000 policy. Done. Easy. But this rule of thumb is not just wrong. It's dangerously, irresponsibly wrong. It's a marketing gimmick, not a financial plan. It's like a doctor prescribing the same pill to every patient, regardless of their illness. It completely ignores the unique reality of your life. Your debts, your mortgage, your kids' future, the rate of inflation, the 10x rule accounts for none of it. It's a guess, a shot in the dark, and your family's entire future is what's at stake. This brings us to the fourth major misconception about life insurance: that a simple rule of thumb is good enough. It's not. Relying on it is one of the biggest financial gambles you can take. Your family deserves more than a guess. They deserve a plan. So let's throw that 10x rule in the trash where it belongs and build a real plan right now using a much smarter, much more effective method. It's a simple acronym you can remember. DIME. DIME. That stands for debt, income, mortgage, and education. This isn't a guess. It's a calculation. It's a personalized blueprint for your family's financial security. Let's break it down step by step. First, D is for debt. This is everything you owe that isn't your mortgage. We're talking about student loans, car payments, credit card balances, personal loans, any financial obligation that would pass on to your family or drain your estate. The very first thing a life insurance payout should do is wipe the slate clean. Imagine the relief for your grieving spouse to have every single one of those debts vaporized overnight. No more car payments. No more student loan bills. Total financial freedom from the burdens of the past. So, your first step is to add up every single one of those debts. Get an exact number. Next, I is for income replacement. This is the most important part of the entire calculation, and it's where the 10x rule fails most spectacularly. The question is not just, how much do you make? The real question is, how many years of that income will your family need to survive and thrive without you? If you have a 2-year-old, your family will need your income for a lot longer than if you have a 17-year-old who's about to leave for college. A good starting point is to plan on replacing your income until your youngest child turns 18, or even 22 to see them through college. Let's say you make $75,000 a year, and your youngest child is 3. You'd want to provide that income for at least 15 years. So you take $75,000 and multiply it by 15. That's $1.125 million right there. That's the money that will keep the lights on, put food on the table, pay for soccer practice, and allow your family to continue living the life you've built for them, without a catastrophic drop in their standard of living. It gives your spouse the option to work less or not at all, while they focus on raising your children through the most difficult time in their lives. It buys them time and stability. Third, M is for mortgage. For most American families, the mortgage is the single largest monthly expense. The DIME method aims to eliminate it completely. You need to figure out the exact amount you still owe on your home. By adding this number to your life insurance calculation, you ensure that your family will own their home, free and clear. The emotional security this provides is immeasurable. No matter what other financial storms may come, they will have a roof over their heads. A stable home, the one filled with memories of you, that they never have to worry about losing. This is a profound gift. It's the foundation upon which they can rebuild their lives. And finally, E is for education. If you have children, you've probably thought about college. You've worried about the skyrocketing costs. A 4-year degree at a public university can now easily top $100,000, and for a private university, it can be more than double that. Life insurance can be the ultimate college savings plan. You need to estimate the future cost of college for each of your children and add that to your total. Even if you already have a 529 plan or other college savings, this ensures that their dream of an education is fully funded, no matter what. It guarantees that your absence won't rob them of their future opportunities. Let's see how this works in the real world with an example. Meet David. David is 38 years old, married with 2 kids, ages 6 and 9. He makes $80,000 a year. If David follows the common, flawed 10x rule, he'd buy an $800,000 policy. He might even feel proud of himself for taking care of his family. But let's see if that's actually enough. Let's use the DIME method instead. First, D for debt. David has $30,000 in student loans, a $20,000 car loan, and about $10,000 in credit card debt. That's a total of $60,000. Next, I for income. His youngest child is 6. He wants to provide for his family until that child is at least 18, so that's 12 years of income replacement. $80,000 a year for 12 years is $960,000. Then M for mortgage. David and his family have a $275,000 outstanding balance on their mortgage. Finally, E for education. He wants to set aside $100,000 for each of his 2 kids for college. That's $200,000. Now let's add it all up. $60,000 for debt, plus $960,000 for income, plus $275,000 for the mortgage, plus $200,000 for education. The grand total David actually needs is $1,495,000. Let's just call it $1.5 million. Look at that difference. The simple lazy 10x rule told him he needed $800,000. But the dime method, the calculation that actually reflects his real life, shows he needs nearly double that amount. 1.5 million. With the 10x rule, his family would have received the money, paid off the debts and the mortgage, and been left with about $465,000. That sounds like a lot, but to replace his $80,000 income, that money would be gone in less than 6 years. His youngest child would only be 12. What happens then? The money runs out. The struggle begins. College is a distant dream. That's the devastating reality of using a rule of thumb. With the $1.5 million policy, the story is completely different. The debts are gone. The house is paid off. There's $200,000 sitting there for college. And there is a fund of nearly $1 million, which, when invested conservatively, can provide a steady, reliable income for his family for well over a decade, allowing them to live without financial fear. That is the difference between guessing and planning. It's the difference between leaving a problem and leaving a legacy. Now, you can and should adjust this. If you have significant savings or investments, you can subtract that from your total need. If your spouse has a high, stable income, you might decide to adjust the income replacement years. The dime method isn't rigid. It's a framework. It's a starting point for a real conversation about what your family truly needs to be okay. It forces you to look at the real numbers, the real future, and to stop gambling with a simple, inadequate multiplication problem. Now, I know exactly what you're thinking. $1.5 million. The number itself sounds intimidating. A policy that big must cost an absolute fortune every month, right? It must be something only the wealthy can afford. This leads us directly to the fifth and final misconception, the one that stops more people from protecting their families than all the others combined: the belief that proper life insurance is just too expensive. Now, I know what you're thinking. A policy for nearly $1.5 million must cost a fortune. That's the single biggest myth that stops people from getting the coverage they need. In the final part of this video, we're going to shatter that myth completely. We'll show you exactly how shockingly affordable the right policy can be, and reveal the one trick that can cut your premium in half. This is the number one reason, the single biggest lie, that stops good people, people who work hard and love their families, from getting the protection they desperately need. It's the myth that life insurance is a luxury, a financial product reserved for the wealthy, for people with corner offices and summer homes. The truth? For most people, a meaningful policy doesn't cost a fortune. It costs about as much as your monthly Netflix subscription, or a few fancy coffees, or one pizza delivery. Let me tell you about a guy named David. David is 42. He's a project manager at a construction company. He's got a wife, Sarah, who's a part-time teacher, and 2 kids, a 12-year-old daughter obsessed with soccer and a 9-year-old son who wants to be an astronaut. They live in a modest 3-bedroom house in a decent suburb, the kind with a park at the end of the street. They have a mortgage, 2 car payments, and the ever-present anxiety of saving for college. David is the primary breadwinner. He's a good man. He feels the weight of his family's future on his shoulders every single day. And for years, David put off getting life insurance. It wasn't because he didn't care. He cared more than anything. It was because in his mind it was an impossible expense. He'd once heard a guy at work, a man in his late 50s, complaining about his $200 a month life insurance bill. That number, $200, got stuck in David's head. $200 a month? That was a car payment. That was groceries for a week. That was the difference between sending his daughter to soccer camp or not. It was an impossible number. So he did what so many of us do. He kicked the can down the road. He told himself, I'll get it when I get that big promotion. Or, I'll look into it when we've paid off the car. He told himself he was young, he was healthy. He had time. Then one Tuesday afternoon, driving home from a job site, it happened. A truck in the opposite lane blew a tire. In a split second of screeching metal and chaos, that truck swerved across the median. David yanked the wheel of his pickup, his heart slamming against his ribs. He felt the sickening lurch as his truck went off the road, bumping violently down an embankment before coming to a jarring halt against a tree. For a few seconds there was just silence. The ticking of the engine, the dust settling in the air. He was okay. Shaken, bruised, but miraculously completely okay. But as he sat there, hands trembling on the steering wheel, his first thought wasn't about the truck. It wasn't about the crash. It was a single ice-cold, terrifying image that flashed into his mind. Sarah trying to explain to the kids why they had to sell their house, why they had to move away from their friends, why their entire world had just been turned upside down forever. In that moment, the abstract idea of what if became brutally, terrifyingly real. That night, David couldn't sleep. The what if played on a loop in his head. He finally sat down at the kitchen table, opened his laptop, and with a sense of dread, typed life insurance quote into Google. He was bracing for that $200 number. He was preparing for the financial gut punch. He entered his information. Age 42, non-smoker, in good health. He was looking for a policy that would cover the $500,000 mortgage and provide some income for Sarah until the kids were out of college. He clicked submit, and the number that came back wasn't $200. It wasn't even $100. For a 20-year, $500,000 term life insurance policy, the quote was $48 a month. 48. He stared at the screen, convinced it was a mistake. He ran the numbers on 2 other sites. The quotes were all in the same ballpark. 45. 52. He felt a wave of emotions wash over him. First, immense relief. Then a slow-burning anger. He was angry at himself. For all those years of worry, of procrastination, of leaving his family completely exposed. All because of a number he'd overheard. A misconception he never bothered to question. So why was his quote so drastically different from the one he'd heard? Comes down to understanding the 2 fundamental types of life insurance, and this is crucial. The guy at David's work likely had a whole life policy. Think of whole life as buying a house. It's permanent, it lasts your entire life, and it builds cash value over time like equity. It's an asset. But just like buying a house, it comes with a much bigger monthly payment. What David was quoted for, and what most young families actually need, is term life insurance. Think of term life as renting an apartment. You're not building equity, you're just paying for the protection you need, for the period of time you need it most, the term. Say 20 or 30 years while your kids are growing up and you have a mortgage. Because you're only paying for the pure insurance protection and not the extra cash value savings component, the cost is a tiny fraction of a whole life policy. For David, a 42-year-old, the difference was $48 versus hundreds. For a healthy 30-year-old, that same policy could be less than $30 a month. But here's where it gets even better. Here is the trick I promised you, the strategy that can literally cut your premium in half over the life of your plan. Most people, when they buy term insurance, do what seems logical. They say, okay, I have a 30-year mortgage. I'll buy a 30-year term policy for $1 million. That makes sense, but it's not the most efficient way to do it. It's like buying a giant moving truck to drive to work every day for 30 years, just in case you need to move a couch one day. A smarter strategy is called laddering or layering. Instead of buying one big, long policy, you buy multiple smaller policies with different term lengths that expire as your financial needs decrease. Let's go back to David. His biggest needs are right now. He has a $500,000 mortgage, and he wants to provide income for his family. But in 10 years, that mortgage will be paid down significantly. In 20 years, his oldest will be through college. In 30 years, the house will be paid off and both kids will be independent. His need for a huge amount of coverage diminishes over time. So, instead of one giant 30-year $1 million policy, he could do this. He could buy a 10-year policy for $250,000, a 20-year policy for another $500,000, and a 30-year policy for $250,000. Look at how this works. For the first 10 years, when his kids are young and the mortgage is high, he has the full $1 million in coverage. He's fully protected. But after 10 years, that first small policy expires. He no longer needs it, and poof, his monthly premium drops. Now, for the next 10 years from year 11 to 20, he has $750,000 in coverage. Still a huge safety net. Then, at the 20-year mark, the second policy expires, right around the time his kids are finishing college. His premium drops again dramatically. For the final 10 years, he's left with the $250,000 policy, a perfect amount to cover final expenses and leave a legacy for Sarah. By structuring his coverage to match his actual needs over time, instead of paying a flat, high rate for 30 years, he's saving a massive amount of money. It's the single most powerful cost-saving strategy in the world of term life insurance, and almost nobody talks about it. It's about being smart, being strategic, and paying only for what you truly need when you need it. The cost of life insurance isn't just a myth. It's a number you have far more control over than you've ever been led to believe. And that control is the secret key that unlocks everything we've talked about today. It transforms life insurance from a dreaded expense into one of the most powerful financial tools you will ever own. Think about the journey we've just been on. We started with this giant, shadowy monster in the room. The belief that this protection is a luxury reserved for the wealthy, a bill so massive it's not even worth considering. But we dragged that monster into the light and saw it for what it was, a myth. We saw that for the price of a few cups of coffee or a streaming subscription, you can secure a future. We saw that the cost isn't a fixed price tag. It's a dynamic number that you influence with your health, your timing, and the type of policy you choose. Then we tackled the myth of invincibility, the idea that being young and healthy means you can put this off forever. But we flipped that script. We realized that youth and health aren't reasons to wait. They are your greatest assets. They are the currency you use to buy the most affordable protection you will ever get. Locking in a low rate in your 20s or 30s isn't just a smart move. It's a financial cheat code for the rest of your life. You are buying certainty in an uncertain world, at a discount that will never be offered to you again. From there, we dismantled the false security of the workplace plan, that comfortable, one-size-fits-all policy that feels so convenient. We exposed it for what it often is, a temporary solution tied not to you but to your job. It's like renting a safety net. The moment you leave, whether you're laid off, find a better opportunity, or retire, that net is gone, and you're left trying to qualify for a new one, often when you're older, less healthy, and facing significantly higher costs. True financial security isn't something you rent from your employer. It's an asset you own, a fortress you build yourself, that moves with you no matter where your career takes you. And who is this fortress for? We shattered the narrow-minded view that it's only for a traditional family with a mortgage and 2 kids. We saw that the modern definition of dependence is so much broader. It's for the business partner who co-signed a loan with you, ensuring the business doesn't collapse if you're gone. It's for the aging parents you might one day support, making sure they're cared for. It's for the person who co-signed your student loans, protecting them from a debt that wasn't theirs. It's even for the single person who simply wants to leave a legacy, to donate to a cause they believe in, or to ensure their final expenses don't become a heart-wrenching burden for their relatives. It's not just about replacing an income. It's about honoring commitments, creating opportunities, and closing your story with an act of profound care and responsibility. Finally, we tore down the wall of complexity, the image of endless paperwork, invasive medical exams, and high-pressure sales calls. We've seen that technology has revolutionized this industry. You can now compare quotes from dozens of top-rated companies in minutes, from your couch, without speaking to a single person. You can apply for hundreds of thousands, even millions of dollars in coverage with an algorithm-driven process that requires no medical exam at all. The barriers to entry have been obliterated. The excuse that it's too much hassle no longer holds water. The industry has been forced to adapt to our modern on-demand world, and the consumer, you, is the one who benefits. So when you put it all together, what do you see? You see that these 5 misconceptions aren't just 5 random, incorrect ideas. They are a system of thinking that keeps people paralyzed. It creates a narrative of powerlessness. It's too expensive, I'm too young, my work has me covered, I don't have kids, and it's too complicated anyway. It's a perfect storm of excuses that prevents people from taking one of the most fundamental steps in building a secure financial life. I want you to think of your financial life like you're building a house. Your income is the frame, the structure that holds everything up. Your savings, your 401k, your investments, those are the walls, the roof, the windows. You work hard every day to make that house stronger, to add new rooms, to make it a safe and comfortable place for you and your family to live. Now imagine there's a chance, however small, of a specific type of earthquake that only targets the frame of the house. It leaves the walls and the roof intact, but it vaporizes the structure holding it all up. What would happen? The entire house would collapse. All those years of building, saving, and investing would come crashing down. Life insurance is not part of the house. Life insurance is the seismic shock absorption system you build into the foundation. It's the one system designed for that one specific catastrophic event. You hope you never ever need it. You build the rest of your house as if it will stand forever on its own. But the reason you can sleep peacefully in that house, the reason you can invest in new furniture and plan for the future with confidence, is the quiet knowledge that if the unthinkable happens, the foundation will hold. The house will not collapse. Your family will not be left homeless in the rubble. That is what this is about. It's not a morbid product. It's not about planning to die. It's about planning to live a life free from the deep, nagging anxiety of what if. It's the ultimate act of offense, not defense. It's you, standing in the present, looking into the future and telling your loved ones, I've got you. No matter what happens, I've made a plan so that your lives can continue with the dignity, security, and opportunity you deserve. Your dreams don't have to die with me. So what do you do now? Where do you go from here, armed with this new perspective? You take action. Not tomorrow, not next week. Today. The cost of waiting is literally measured in dollars. First, get a rough idea of how much you need. Don't pull a number out of thin air. A simple framework people use is the DIME method. D for debt. Add up all your non-mortgage debt, like credit cards and student loans. I for income. Multiply your annual income by the number of years your family would need support. 10 is a common starting point. M for mortgage. Add the remaining balance on your mortgage so they can pay off the house. And E for education. Estimate the future cost of college for your children. Add it all up. That number might seem huge, but it's a real number. It's your starting point. Second, go online to a reputable independent marketplace. Not an insurance company's website, but a broker's site that lets you compare dozens of them at once. Spend 10 minutes. Type in your age, your health status, and that coverage amount you just calculated. See the real numbers for yourself. You will be shocked at how affordable a 20 or 30-year term policy can be. This one act will permanently destroy the "it's too expensive" myth in your mind. Third, if you have a complex situation, you own a business, have a unique health history, or high net worth, don't be afraid to talk to an independent financial advisor or broker. These professionals aren't tied to one company. Their job is to find the best possible solution for you across the entire market. They can be invaluable guides. But the most important step is the first one. It's the decision to move from passive worrying to active planning. Even if you start with a smaller policy than you think you need, starting is everything. A $250,000 policy that costs you $20 a month is infinitely better than the perfect multi-million-dollar policy that you never get around to buying. The myths we've busted today are more than just misinformation. They are thieves. They steal your peace of mind in the present and your family's security in the future. They thrive in silence, in procrastination, in the conversations we're too uncomfortable to have. But you have the power to end that right now. This isn't just about a policy or a payout. It's about a promise. It's the gift of time, the gift of choice, the gift of a grieving family not having to make devastating financial decisions in the worst moments of their lives. It's the gift of staying in their home, of kids staying in their school, of a future that, while different, is not destroyed. The conversation about life insurance is not a conversation about money. It's not a conversation about death. It is the ultimate expression of how you want your life to continue to be a source of strength, support, and love, long after you are gone. It is the final love letter you will ever write. Go write it.